Hey folks, okay, so this is a pretty important one and I hear it all the time and I just wanted to weigh in. Should I sell in a market downturn? Can I set out a slump? How do I time the market? What do I do? How do I beat the market? The answer to all of that is just no. Just no, no to all of that, and I will explain why. Uh, so first I need to warn you, it's not financial advice, this is not legal advice. I'm just trying to help. This is my opinion. This is an amateur opinion. They're not anybody else's opinions. I'm not selling anything. I don't sell services or investments. I'm just focusing on the US, just for right now in the 2020 era. And this is just educational. So I hope you enjoy. I'm not trying to sell anything. Take it or leave it. Now, just in case you pay attention to nothing else, do not sell. Do not sell. The answer is no. Do not sell in a market downturn if you are a long term investor. Stop panicking. Do not time the market. Stop using hindsight. You're not a time traveler. Markets will recover. Just a few days can change everything. So we'll hit all of these points, but you gotta know the answer is no. And now I'm gonna explain why the answer is no. Calm down. So first, stop panicking. It's the most important thing. Panicking is expensive. You need to stop panicking. This whole presentation is just why to stop panicking. But if you just want to know what to do, stop panicking. Stop following. Stop worrying about it. The most important thing you can do. If your long-term strategy was applicable before a downturn, it's still applicable now. And that's all you need to remember. Leave it alone if that's your long-term strategy. You just got to follow through. You got to you stay on the road, you follow the map, you're going to get to your long term goal. Do not deviate just because you've got a short term bump in the road. If you have to, stop checking your count, stop checking your balance. If you have to, stop watching the news, stop listening to the news, stop reading the news, turn off your social media feeds if that's where you're getting it. Change to something else if you cannot stop panicking. But you need to stop panicking. It's expensive. It's expensive because you're going to make bad choices. Now, this is important. You cannot time the market. Do not just sell because the market starts to drop. You don't know what's going to happen next. It could continue going down. It could go up. It could go up and down. It could go down and up. It could go up, down, up, down, up, down. It could do anything. You don't know what's going to happen. You might sell too late to avoid the worst of it. You might have already missed it. You might buy back in too late to get the rebound. You just don't know what's going to happen. The important thing, as people say, is not it's time in the market, not timing the market. This is an important phrase. It's a bit of a cliche, but you need to remember it. Time in the market, not timing the market. You cannot time the market. Timing the market is when you're trying to predict where the market's going. If you could time the market, you'd buy and sell at the right times. You would buy just before the best days, and you'd sell just before the worst days. You'd get all the gains and none of the losses. Now, you don't know when the best days are. You don't know when the worst days are. You might think you know, but usually you're just relying on hindsight. You don't know going forward when the best and worst days are. Now, you might get time in the market very easily. All you have to do is buy. Just buy a broad index and wait. It's very easy. You can't really mess it up unless you sell. Now, if you buy and hold, you're in the market, you're going to get those best days. The downside, the disadvantage is you have to not panic after the worst days, and then you can get those best days. Now, remember, you're not a time traveler. Stop using hindsight. You are not a time traveler. So stop investing as if you're a time traveler. There are lots of different movies out there, and if you notice, they all have a few things in common, right? Either the time travel, which seems so miraculous, either it just doesn't work, or it causes some unforeseen problems, some unintended consequences, or it has some terrible cost, some unexpected downside. Even in science fiction, time travel comes with costs. You don't even have time travel, so stop acting like you do. You might think you know when the market's going to drop. You think you know when it's going to bottom, when it'll recover, when it'll peak. You think you know all of these things, but you're wrong. You don't know those things. When you time the market, you're indulging in hindsight. You do not get to invest with hindsight. The important thing to remember is markets will recover. That's why you just need to stop panicking and wait for the recovery. Even after very long bear markets, even after their significant downturns, full recovery usually happens. Often within 3 years is usually the estimate, but it's often much shorter. It depends on the size. But even the biggest downturns, it's often much faster. And the main exception here is really war, but also sometimes maybe like a Great Depression. But even then, it's really just The experience in the United States is that markets recover. They recover quicker than you think. So unless you are expecting to withdraw most of your money in the next few years, don't sell in a downturn. Wait for the recovery. Now, you can't time the market in the short term, but you do know that you can time it or not time it, that you can get the benefit in the long term. So it's going to grow. We don't know what's going to happen in the short term. We do know long term that it's going to grow. Now, the historical annual stock returns, which are post-inflation, according to the rate of return on everything, which is a great publication, and it continues to get updated. And this is just focusing on the US. 1980 through 2015, they estimated 9.3%. 1950 to 2015, they estimate 8.89% annualized return. And all the way back to 1872, 8.5, 8.46%. That's an amazing historical return, and that's annualized. That's every year on average. So if you're in for the long term, you're going to get an annual return that looks something like that, or at least you can reasonably expect to get that type of annualized return. Now, that includes all of these major downturns, yet we still have those dramatic overall long-term gains. So you've got the financial crisis where S&P dropped over half. You've got the tech bubble and 9/11 where almost half of the S&P was off peak. The invasion of Kuwait where it lost almost a fifth. And then you've got Black Monday, 1987, when it lost almost a third over that period. And yet you get amazing long-term returns in the S&P. So it really is incredibly powerful. Despite all of those downturns, despite those slumps, the S&P 500 did really well. And that's just something that you can take advantage of. But even though you can't, so you can't time it in the short term, you know it's going to grow in the long term. And that's despite all of the volatility, all these big drops that you're seeing, but it doesn't come all at once. It's unpredictable when that growth is going to come. Just a few days can change everything in terms of growth. So long-term investment will get you robust returns. And this is just focusing on the S&P 500, but it does apply generally if you were to do, say, total stock market or other broad indices, it would also apply. But just focusing on the S&P 500 because it's easier to measure, we've had a lot of analyses that have come out and saying over the long term, even if you're in for 10 or 15 or 20 or 30 years, over half the gains from that period come from a very few number of trading days, perhaps 10 or 20. So Putnam did a study and they looked at 2005 through 2019. What they found is the 10 best trading days were worth 54% of all the gains in those years, and the 20 best days were worth 87% of all the gains in that period. Now, if you missed those days, you barely got anything out of your return or out of your investment. You got almost no return. You did not want to even be in there if you couldn't get those days. You don't know when those days are going to happen, but those are the days that you want to be in for, just those very few days. It's not all the rest of the time, all the 99.8% or whatever of the days that you're in there are not going to be worth as much as these 10 or 20 best days. And JP Morgan did a similar study, and they looked at 2000 to 2019. And they found that in their study, 10 best days were worth 60% of the gains in that period, and that the 20 best days were worth almost 99% of the gains from 2000 to 2019. That's incredible. If you missed those days, if you missed just a tiny percentage of the total trading days, you might as well have just had cash under your mattress. So that's incredible. But the important thing is, yeah, if you miss the 10 best days, you're going to miss most of the gains. And if you miss the 20 best days, you can miss almost all the gains, right? The important thing is you don't know when those days are going to happen. So a relatively small number of days will get you all of your gains, or nearly all of your gains, or certainly most of your gains. When you don't know when they're going to happen, you don't want to sell in a downturn, you might miss those best days. And if you miss just a few of those best days for every downturn when you're selling, that could be incredibly expensive. So the question, should I sell in a market downturn? Can I wait out the slump? How do I time the market? The answer to all of that is just no. No to all of it. No to everything you're thinking. No to your hopes and dreams. No to your fantasies. You're not a time traveler. Just stop. Wait. So let's do the takeaways in case you missed it. Stop panicking. Panicking is expensive. Over the long term, a large cap index is going to do very well. Most of those gains are going to come from just a dozen or so days. Since you cannot time travel, you do not know when the best days will be when you invest. If you panic and sell, you might miss the best days. But if you wait, you should be fine long term. That's always what the S&P 500 has done. That's what it's been doing for decades and decades. It's several generations of robust long-term returns. Panicking is expensive. You'll miss those best days. You'll miss those returns. Calm down, and if you have to, stop watching the news. Stop checking your account. Just wait. You'll be fine. All right, so thank you so much. I appreciate your time. I apologize if it comes off a little blunt, but I just need to be very clear. This is not ambiguous. This is great advice. I'm just trying to help. I am not giving you financial advice. I'm just trying to help anybody who's interested in figuring out what to do. The answer is do not panic. Stop panicking. Just let it sit. If you've got a few years, then let it sit. Thank you so much again for your time, and I wish you well.